Warren Buffett once stated that The Intelligent Investor was by far the best book on investing ever written. Buffett first read this book when he was only 19 years old and still applies the principles of this book to his investing decisions today. The Intelligent Investor was written by Buffett's mentor, Benjamin Graham, and is filled with over 500 pages and 20 chapters of investment wisdom. And in this video, I'm going to be briefly summarizing each chapter and analyzing the key concepts. So let's jump in. Chapter 1 is investment versus speculation. One of the most common mistakes made by beginners is they're actually speculators, not investors, and this is a mistake I personally made. Speculation is essentially gambling on the movement of certain stocks. For example, if we look at AT&T, this is a large company that's been around for a very long time. And if we look at the March 2020 crash, we can see they were trading as low as $20 per share, which is the lowest they had traded in a long time. So a speculator might say, wow, this company looks very cheap. But in reality, the fundamentals of the company were not strong at the time, and we can see the share price has continued to decline since then. But an investor would have looked at the underlying fundamentals of the company. They would have seen key concepts such as the fact that AT&T was drowning in debt. The true investor doesn't pay as much attention to the share price of the company, they pay more attention to the intrinsic value. That's what the company is actually worth. So we can see some key differences between investors and speculators. For example, investors focus on the fundamental factors of the company, such as are they growing earnings, what does their debt look like, their cash position, while speculators focus more on charts and market psychology. Typically, investors focus on a long time horizon, while speculators focus on a short-term time horizon. And because investors focus on quality companies, they typically have only moderate risk, while speculators typically have much higher risk. Again, the key concept here is investors focus on the underlying fundamentals of the business. They remember that a stock is not just a stock with a share price moving around, it's an actual business. Chapter 2 is the investor and inflation, and in this chapter, Benjamin Graham discusses how inflation erodes purchasing power and affects investment returns over time. And more specifically, he describes how bonds are particularly vulnerable to inflation since their payouts do not increase with rising prices. We have to remember, inflation compounds over time just like any other investment. So for example, if your monthly cost of living right now is $4,000, assuming just a modest 2% inflation rate in 30 years, your cost of living would jump all the way up to $7,245. The solution to this is to buy stocks that are growing their earnings at a rate higher than inflation. Chapter 3 is a century of stock market history. If you pay attention to the history of the world, it seems like there's always something going wrong. We've had 2 world wars, we've had real estate collapses, financial crises. And despite all of this, long term, the market has continued to go higher and higher. So while short term, the market can go up and down for quite a long time, over the long term, the market goes up, which is why it's important to keep a long-term perspective. Chapter 4 is general portfolio policy, the defensive investor. Graham basically recommends, if you're a defensive investor, a balanced portfolio of 50% stocks and 50% bonds. And on top of that, if you're very risk averse, you should be focused on high quality dividend paying stocks. For example, look at the Coca-Cola company. If we jump over to my dividend breakdown sheet, which you can download on tickerdata.com, I'll come up here and plug in KO, and all this data will automatically load in. And what we can see is Coca-Cola has a rich history of increasing the amount they pay out to dividends to their shareholders every single year. In fact, this company is a dividend king with over 50 consecutive years of paying out dividends and growing those dividend payments. Chapter 5 is the defensive investor and common stocks. And in this chapter, Graham gives us some guidelines for selecting stocks as part of a defensive strategy. He says we should look for things like solid track records of earnings growth, strong financial position, and a history of dividend payments. And an example of this could be the PepsiCo company, stock ticker PEP. If we jump over to my profitability spreadsheet, come up here and plug in PEP, this data will load in and we can see a few different things. First off, look at the revenue. Revenue has been growing at a steady but consistent rate over the past decade. And the same is true with the earnings per share. And something else we can see is the gross profit ratio has remained steady, which is a good sign. The 10-year gross profit ratio average is 54.3%, and the 2023 gross profit ratio was 54.48%. On top of this, if we jump over to the dividend breakdown sheet, we can see PepsiCo not only has a decent starting dividend yield sitting at about 3%, but they're growing those dividend payments every single year. And in fact, if we look at the 10-year dividend growth rate, it's sitting close to 8%. So on average, they're increasing those dividend payments at around 8% every single year. Chapter 6 is the portfolio policy for the enterprising investor, the positive side. And this is where Graham suggests trying to buy stocks that are undervalued, which basically means they're trading below their intrinsic value. For example, we can see on this chart, here on the x-axis we have time, and on the y-axis we have share price. If we look at this black line, it's showing the share price of a stock over time. And if we look at this red line, it's the intrinsic value of the company, what the company is actually worth. And what we can see is long term, yes, the share price does follow the intrinsic value of the company, but over the short term, there can be a lot of fluctuations. We can see time periods where the stock is undervalued and then time periods where the stock is overvalued. So the key here is to try to buy stocks when they're undervalued. Again, meaning that the share price is below the intrinsic value. Chapter 7 is portfolio policy for the enterprising investor, the negative side. And basically he warns us the dangers of speculative investments. And some examples of this are penny stocks or IPOs. And we can see here 2/3 of IPOs underperform their relevant benchmark indexes. So Graham recommends staying away from penny stocks and IPOs. Chapter 8 is the investor and market fluctuations, and Warren Buffett has stated before that this is actually one of his favorite chapters in the entire book. And in this chapter, Graham introduces a metaphor to us of Mr. Market, and this is a personification of the stock market's emotional volatility. Now, basically, we know on a compound interest calculator what the growth of our investments looks like, and you can see underneath this red line is what a 7% annual rate of return would look like by investing $10,000 annually. But in reality, that's not how our portfolio is going to grow. It's going to look a lot more like going up, then going down, going up, and going down. Basically, the market can be volatile, but long term, it does continue to grow. And to emphasize this point, this is actually something I talked about on my free weekly newsletter not too long ago. We often hear, typically, on average, the market returns around 7%, but we have to keep in mind that's simply an average. Oftentimes, we can see the market producing huge numbers in a single year and pretty bad numbers in a single year. For example, we've seen the market return negative 10% to 0% just as often as 0% to 10% from 1928 to 2023. We've also seen 6 different years where the market has returned negative 10% to negative 20%, and then 6 years where the market has returned negative 20% or more. Now, on the flip side of this, the most common occurrence is for the market to return 10% to 20%. So yes, the reality is the average may be around 7 or 8% for market returns, but you have to be able to handle volatility. And this is where we get one of the most famous quotes of all time from: buy when others are fearful and sell when others are greedy. Chapter 9 is investing in investment funds. Now, there's a lot of phenomenal investment funds out there that can give you a properly diverse portfolio just by investing into one simple ETF. But you have to be careful because some of them actually do have some drawbacks. And the most important thing that you want to look out for is the expense ratio. A high expense ratio can have a drastic impact on the long-term performance of your portfolio. For example, we can see this blue line here is the S&P 500 returns over time, and the red line below it is with a 0.1% fee. There's definitely a difference right here, but look at this. If the fee overall was 1%, there is a drastic difference in the S&P 500 returns versus the S&P 500 with a 1% fee. So we want to look for funds with a low expense ratio. And for example, if we look at stock ticker VOO, this is the Vanguard S&P 500 ETF, we can see the expense ratio is just 0.03%. Now, what does this mean? Well, basically it means for every $10,000 you invest into the fund, you're only going to pay $3 in fees. That's a pretty good expense ratio. So typically you should look for funds or ETFs that have an expense ratio of less than 0.1. Chapter 10 is the investor and his advisors. And really the most important part about this is the chapter emphasizes the need for transparency, reasonable fees, and a focus on the investor's long-term goals. Ben Graham encourages investors to remain educated and involved in their financial decisions rather than relying entirely on advisors. For example, if you do decide to use a financial advisor, you should make sure that you're evaluating your financial needs, understand the different types of financial advisors, learn what the advisor does and what the cost of the advisor is, research different advisors, and definitely walk away if it doesn't feel right. And most importantly, your financial advisor should be teaching you. It shouldn't be a secret what they're doing. Chapter 11 is security analysis for the lay investor, general approach. Benjamin Graham basically gives us some key metrics we could look for to start evaluating stocks. For example, one of the metrics he lists is the price to earnings ratio. We can see right here, for example, American Express Company currently has a price to earnings ratio of 19.18. What does this mean? Well, if we take the current share price of the company and divide it by the forward-looking earnings per share, we get the price to earnings ratio of 19.18. This is basically telling us how much we're willing to pay for the earnings of the company. He also mentioned some metrics on the balance sheet we should look for. So if we come up here and plug in AXP, again, thanks to ticker data, this data will automatically load in. And one of the things we can see is the debt to assets ratio. This is basically telling us how much total debt the company has in relation to the total assets. So we want a low debt to assets ratio. This is total debt divided by total assets, and for AXP at the end of 2023, total debt was sitting at about $49 billion, while total assets at $261 billion. So their debt to assets ratio looks really good. Chapter 12 is things to consider about per share earnings. Earnings per share is a very important metric, and it's looked at pretty often by investors, but it does have some potential problems which we need to point out. For example, if we come up here and plug in stock ticker Apple, what we can see is earnings per share over the past decade has grown by quite a bit. It's gone from around $1.43 all the way up to $6.16. But there's a few different ways that the earnings per share of a company can be manipulated, and one of those ways is by buying back shares. Now, share buybacks can be a good thing for investors, but you have to understand, when a company is buying back their own stock, it's going to boost all of their per share metrics like earnings per share or revenue per share or free cash flow per share. And for example, if we jump over to my profitability and income statement sheet, we're looking at Apple. One of the things we can see is revenue from 2022 to 2023 actually decreased for Apple, going from around $394 billion down to around $383 billion. But if we jump back over to our stock screener, we can see revenue per share from 2022 to 2023 actually slightly increased, even though organic revenue decreased. And the reason behind this is because the company was buying back shares. So it's important to keep that in mind. But in regards to earnings per share again, we also have to remember, earnings per share can be manipulated by different accounting practices. And it can also be manipulated by changes to the capital structure. So sometimes earnings per share isn't the best metric to look at. That's actually why I prefer to look at free cash flow per share. The free cash flow per share won't lie to you. Chapter 13 is a comparison of 4 listed companies, and basically, he gives some examples of some of the things we've already talked about so far. He talks about the differences between companies with strong fundamentals and those with speculative characteristics. And really, the case study points to what we've already talked about. We want to look for companies that are growing their top and bottom lines. We want to look for companies with a healthy balance sheet. And of course, we also want to have a long-term perspective. And then lastly, we want to make sure we're avoiding investments that are being driven by hype or speculation. Chapter 14 is stock selection for the defensive investors. And in this chapter, he begins outlining specific criteria for selecting stocks. And the general criteria boils down to the minimum size of the company, having a strong financial position or low debt levels, a consistent earnings record, and a history of dividend payments. But we should also take into account the business model. For example, I think Waste Management is a great example of a highly defensive stock. The company has a business model that's not going away anytime soon. The trash truck is going to come pick up your trash every single week on a consistent basis. And if we look at the fundamentals of the company, we can see that's reflected. Revenue per share year over year is slowly but steadily growing. The same is true with the earnings and the free cash flow per share of the company. If we look at the balance sheet, we can see a healthy debt to assets ratio. And then finally, if we look at the dividend history for the company, we can see those dividend payments are growing every single year, and those dividend payments are being covered by the company's free cash flow. Chapter 15 is stock selection for the enterprising investor. And in this chapter, Benjamin Graham suggests that for people that are looking to be very aggressive with their investments, they should consider things like small cap stocks, companies with temporary difficulties, or those in cyclical industries. Now, finding these type of companies typically require a higher level of research, analysis, and market awareness. And an example of this would be Ford, the motor company, back in 2008-2009. We can see here, the company was trading as low as around $2.46 per share. The company was definitely out of favor and was facing a lot of temporary difficulties. But the reality is the company was trading far below its intrinsic value based on its assets and earning potential. Keep in mind, this style of investing is quite a bit riskier than the other styles we've talked about. Chapter 16 is convertible issues and warrants, and in this chapter, Graham discusses convertible securities, which combine features of both stocks and bonds and warrants, which give the holder the right to purchase stock at a specific price. For example, we can see a warrant is a derivative security that gives the holder right to purchase specified number of shares at a stated price, while convertibles are the derivative securities in the form of a bond or preferred stock, which can be converted into specified number of shares of a common stock on the investor's choice. There are some benefits to these instruments, but they often have higher risk and more complexity. So the key takeaway here is you should only consider these style of investments if you completely and fully understand their mechanics and risks. Chapter 17 is 4 extremely instructive case histories, and this chapter presents 4 in-depth case studies of companies, each chosen to illustrate different aspects of investment analysis and decision making. Case example number 1 was an overpriced business on its last legs. And this company saw its share price drop from $86.50 to $5.50 per share. This mispricing was caused by the neglect of warning signals of financial weakness and inadequate interest coverage. That's an important balance sheet ratio we should be paying attention to. There was also suspicious earnings, overpriced bonds, and low profitability relative to competitors. Case example number 2 was a company who saw revenues rise to $3.75 billion in 1969 before collapsing to $374 million the following year. This was mainly due to management's reckless expansion strategy, but there were also some other indicators such as excessive debt and insufficient earnings. Case study number 3 was an example of an absurd hostile takeover. A company with a market capitalization of $1.3 billion launched a hostile takeover bid for Martin Marietta, a company 6 times its size. This led to excessive leverage and inadequate earnings. And case study number 4 was about a company that went public in 1969, touting itself as a provider of data processing services to Fortune 500 companies. But here's one of the big problems. They were recognizing revenue before it was earned and overstating profits. Chapter 18 is a comparison of 8 pairs of companies. In this chapter, Benjamin Graham takes a look at similar businesses with different financial health and valuation metrics. And I think there's 10 key takeaways from this chapter. Point number 1 is the importance of fundamentals over market sentiment. Graham emphasizes that the intrinsic value of a company is far more important than its current market price, which can be often influenced by temporary factors such as market sentiment, hype, or fear. Number 2 is comparison of business models and industry positioning. The key point here is when comparing companies, it is crucial to understand their business models and how they are positioned within their industry. Number 3 is financial health and stability. A company's financial stability, including its debt levels, liquidity, and profitability, is crucial in assessing its long-term success. Point number 4 is an important one, and that is management quality and corporate governance. Basically, the competence and integrity of a company's management team are essential factors in determining its potential for success. Number 5 is earnings consistency and predictability. Companies with consistent and predictable earnings are generally safer investments compared to those with volatile earnings. Investors are willing to pay a premium for companies with very predictable cash flows. Number 6 is diversification within business operations. Think of companies like Microsoft's. These are companies with diversified operations or a broad product portfolio, and these companies are generally more resilient to market changes. Point number 7 is market position and competitive advantage. Companies with a strong competitive advantage or dominant market position are more likely to provide sustained returns. Key point number 8 is avoidance of overvaluation and speculative bubbles. Investors should avoid companies whose stock prices are significantly inflated relative to their intrinsic value. Valuation matters. Number 9 is margin of safety principle, and this is something we'll talk more about in chapter 20, but the key point is the margin of safety principle is central to all investment decisions, providing a buffer against errors in judgment and market fluctuations. And then key point number 10, learning from historical comparisons. Historical comparisons provide valuable lessons on market behavior and investment outcomes. Chapter 19 is shareholders and management's dividend policy. Now for me personally, I love buying stocks that pay dividends, but that doesn't mean every stock that pays a dividend is a good company. In fact, some companies that are paying dividends should probably not be paying dividends at all. If we jump over to my dividend breakdown sheet, let's look at an example. Let's go ahead and look at Walgreens stock. What we can see is Walgreens currently has a very high starting dividend yield, and over the past decade, it's been increasing the amount it pays out in dividends every single year. But there's a major problem here. If we look at 2013 through 2021, we can see the free cash flow has been covering those dividends for that time period. Now keep in mind, free cash flow is the money that remains after a company pays for everyday operating expenses and capital expenditures. And there are 5 different things that a company can do with free cash flow. 1, they can reinvest back into the business. 2, they can pay out dividends. 3, they can buy back shares. 4, they can pay down debt. And number 5, they can attempt mergers and acquisitions. So the job of management is to strategically decide how to use their free cash flow. So ideally, the dividend payments aren't larger than the free cash flow, because if dividend payments are larger than free cash flow, then those dividend payments won't be sustainable and the company will likely have to cut their dividend payment. And unfortunately, that's exactly what happened to Walgreens. What we can see is for a while here, free cash flow was easily covering those dividend payments. For example, look at 2019. Free cash flow was about $3.8 billion, while total dividends paid out was about $1.6 billion. But then if we look all the way in 2022, it gets a lot closer. Free cash flow was about $2.1 billion, while dividends paid out was sitting closer to about $1.65 billion. So they're using most of their free cash flow to pay out dividends here in 2022, leaving very little capital to reinvest back into the business and pay down debt. And then in 2023, we saw a disaster. Free cash flow was only $141 million, while dividends paid out was $1.6 billion. This is not sustainable, so the end result was Walgreens had to cut their dividend payment. We can see here, their dividend payment per year is now sitting at just $1, which is much lower than it was in 2023 at $1.92, and it's even lower than it was in 2013 when it was $1.18. So when buying dividend stocks, you should make sure you're looking for companies that are growing free cash flow and their free cash flow is easily covering those dividend payments. Chapter 20 is margin of safety as the central concept of investment. And again, this is one of Warren Buffett's favorite chapters. And the general idea is that investors should only purchase securities when their market price is significantly below their intrinsic value. For example, we can see here, this is a spreadsheet I built to find the intrinsic value of stocks. And on the spreadsheet, there's 4 different valuations that I use to find their intrinsic value. And in this example, the average intrinsic value for the stock I'm looking at was $172.04 per share, while the current share price for this company is sitting at $158.68. So it looks like it may be slightly undervalued, but here's the thing, we have to apply a margin of safety. Maintaining a margin of safety is crucial for both defensive and enterprising investors, as it helps ensure long-term investment success. So for some people, they apply a margin of safety at 10%, and more defensive investors might apply a margin of safety of 20%. But for example, if I apply a 10% margin of safety right here, we could see my acceptable buy price for the stock I'm looking at would be $154.83, meaning I shouldn't buy the stock because the current share price is sitting at $158.68 if I were to apply a 20% margin of safety. That means my acceptable buy price is $137.63, which is 20% lower than the intrinsic value that I found. Applying a margin of safety can help you from making a lot of investment mistakes. The principles from the book The Intelligent Investor are so good that they've stood the test of time. Warren Buffett still applies these principles today. This book has also personally shaped the way that I invest. If you'd like to learn more about these principles and concepts, I'd encourage you to read the entire book. And if you'd like to get access to any of the spreadsheets you saw in this video and also the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. This is personally how I analyze companies and look at their fundamentals. And if you want to learn even more about these principles, I'd also encourage you to sign up for my free weekly newsletter. So with all this being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.